Picture this. You spend 3 months clicking buttons, connecting wallets, and jumping through hoops for what crypto influencers promise will be life-changing money. The airdrop finally drops and you get $17. Sound familiar? Today we're diving deep into the brutal reality of crypto airdrops. And I'm going to give you the honest answer nobody else will. What's up everyone? Welcome back to the channel. If you're new here, I break down everything crypto in plain English without the hype and BS. Today we're tackling one of the most controversial topics in crypto airdrops. Are they actually worth your time? Or are you better off flipping burgers at McDonald's? By the end of this video, you'll know exactly which airdrops are worth pursuing, which ones to avoid like the plague, and most importantly, how to calculate if your time investment actually makes sense. We're also going to cover some strategies that 99% of airdrop hunters completely ignore, and I'll show you real data from my own airdrop experiments over the past 2 years. But first, let me tell you about the 23-year-old college student who made $47,000 from a single airdrop while studying for finals. No, this isn't clickbait. This actually happened, and understanding why this worked while most airdrops fail miserably is the key to everything we'll discuss today. Let's start with the basics. What exactly is a crypto airdrop? Simply put, it's when a blockchain project gives away free tokens to users who meet certain criteria. Think of it like a marketing campaign where instead of getting a free sample of shampoo, you get cryptocurrency that might be worth something someday. The idea sounds incredible on paper. Use a protocol, get rewarded with tokens when they launch. Projects get users get paid for testing their platform. Everyone wins, right? Well, that's where things get complicated. Here's what actually happens in 90% of cases. You hear about a potential airdrop from Twitter or Discord. The requirements seem simple. Make a few transactions, hold some tokens, maybe stake something for a while. You think it'll take an hour. 6 months later, you're still grinding daily tasks like you're playing some twisted mobile game. The psychology behind this is fascinating and frankly a bit manipulative. Projects intentionally make the requirements seem easy up front. They know that once you've invested time, you're psychologically committed to seeing it through. It's the same principle casinos use with progressive jackpots. Let me share some real numbers with you. Last year, I tracked 27 different airdrop opportunities from start to finish. I spent an average of 4 hours per week across all of them. That's roughly 200 hours of work over the year. My total earnings? $3,200. That works out to about $16 per hour. Now $16 an hour isn't terrible, but here's the catch. Most of that came from just 3 airdrops. The other 24 either didn't happen, gave tokens worth less than $5, or had such restrictive eligibility criteria that I didn't qualify despite months of activity. This brings us to the first harsh reality. Airdrop hunting is incredibly top-heavy. A few big wins subsidize dozens of failures and mediocre payouts. It's like being a startup founder where one success has to make up for all the failures. But let's talk about that college student I mentioned earlier. His name is Marcus, and he made $47,000 from the Arbitrum airdrop in March 2023. Here's the thing though, Marcus wasn't airdrop hunting. He was genuinely using Arbitrum for DeFi activities because he believed in the technology. He had been an active user for over a year, had significant transaction volume, and was providing liquidity to various protocols. This highlights the most important principle in successful airdrop farming. Authenticity trumps gaming the system. The projects that deliver the biggest airdrops are usually the ones looking for genuine users, not people gaming their criteria. Think about it from the project's perspective. They're giving away potentially millions of dollars worth of tokens. Do they want those tokens going to their actual community who will stick around and contribute, or to mercenary farmers who will dump immediately? The most successful airdrops in history, like Uniswap, Ethereum Name Service, and DYDX, all rewarded early genuine usage rather than people following specific farming guides. The users who made the most money were the ones who weren't even trying to farm airdrops. This creates a paradox. The more you try to game airdrops, the less likely you are to qualify for the big ones. Meanwhile, the people making real money are just using crypto naturally for their own purposes. So does this mean airdrop farming is completely worthless? Not necessarily, but it means your approach needs to be fundamentally different from what most people are doing. Here's my framework for thinking about airdrops intelligently. First, never chase airdrops as your primary activity. Instead, use protocols you genuinely find interesting or useful. If there happens to be airdrop speculation around them, great, but that shouldn't be your main motivation. Second, understand that your time has value. If you're spending more than 5 hours a week on speculative airdrop activities, you're probably not optimizing your life very well. Unless you're unemployed or this is genuinely your preferred form of entertainment, that time could almost certainly be better spent elsewhere. Third, focus on quality over quantity. Instead of farming 50 different protocols superficially, pick 3 to 5 that you actually understand and engage with them meaningfully. Build real transaction history, understand the technology, participate in governance when possible. Fourth, have realistic expectations. If an airdrop guide promises you'll make thousands of dollars for minimal effort, it's probably too good to be true. Most successful airdrop farmers think in terms of building a portfolio of potential opportunities rather than expecting any single one to pay off big. Let me walk you through what this looks like in practice. Instead of following a guide that says, make exactly 3 transactions on Protocol X, you might decide to genuinely try using Protocol X for something you actually need. Maybe it's a new decentralized exchange with better fees, or a lending protocol with attractive yields. You use it naturally for a few months. You understand how it works, you have legitimate transaction history, you maybe even provide feedback to the team or participate in community discussions. If an airdrop happens, you're much more likely to qualify and receive a meaningful amount. Even if no airdrop happens, you haven't wasted your time because you were doing something you found genuinely valuable. This is the mindset shift that separates successful airdrop hunters from the people burning hours for $17 payouts. Now let's talk about some specific strategies that work better than mindless farming. One approach is ecosystem farming. Instead of farming individual protocols randomly, focus on entire ecosystems that are likely to have multiple airdrop opportunities. For example, if you believe a particular Layer 2 blockchain has potential, become a genuine user of that entire ecosystem. Use their DeFi protocols, trade on their DEXs, bridge assets back and forth, maybe even deploy a smart contract or 2 if you have the technical skills. This approach has several advantages. First, you're more likely to qualify for multiple airdrops within that ecosystem. Second, you develop genuine expertise in that blockchain which can be valuable regardless of airdrops. Third, you're making educated bets on technology you actually understand. Another effective strategy is governance participation. Many projects specifically reward users who participate in governance decisions, not just those who have high transaction volume. This requires more effort upfront to understand the projects and proposals, but it often leads to better airdrop outcomes. The reason governance participation works is that it demonstrates genuine long-term interest in the project. Someone who votes on proposals clearly cares about more than just extracting value, which is exactly what projects want to reward. Here's something most people completely overlook: timing your activities strategically around market cycles. The best time to start using new protocols is during bear markets when fewer people are paying attention. Competition is lower, your genuine usage stands out more, and you have time to build substantial history before airdrops actually happen. During bull markets, everyone floods into protocols chasing airdrops, making it much harder to stand out and much more expensive to be active due to high gas fees. The smart money starts farming during boring periods when nobody cares. Let's discuss some red flags that indicate an airdrop opportunity probably isn't worth your time. First, if the requirements are extremely specific and unnatural, like make exactly 7 transactions of at least $50 each on Tuesdays, that's a sign the project is more focused on gaming metrics than finding genuine users. Second, if the airdrop speculation is entirely driven by anonymous Twitter accounts with no connection to the actual project, be skeptical. Legitimate airdrops usually have some hints or communication from official sources. Third, if participation requires significant upfront costs or ongoing fees that eat into potential rewards, do the math carefully. I've seen people spend hundreds in gas fees chasing airdrops worth less than $50. Fourth, be wary of protocols that seem to exist primarily for airdrop farming rather than solving real problems. Projects built around artificial utility rarely deliver meaningful airdrops because they don't have sustainable business models to support token value. Now let me share some specific examples of what good and bad airdrop strategies look like. Bad strategy. Following a Twitter thread that tells you to make 5 specific transactions on a protocol you've never heard of, spending $30 in gas fees, and hoping for the best. Good strategy. You're interested in decentralized derivatives trading, so you start using a new derivatives DEX because you actually want to trade derivatives. You use it regularly for 6 months, provide feedback to improve the platform, and maybe even refer some friends who are also interested in derivatives trading. Bad strategy. Spreading $50 across 20 different protocols to meet minimum requirements while understanding none of them. Good strategy. Putting serious money to work in 2 protocols you've researched thoroughly, using them for legitimate purposes, and building substantial interaction history. The difference is intentionality and authenticity versus spray and pray speculation. One approach occasionally leads to life-changing money, the other leads to consistent disappointment and wasted time. Here's another crucial point. Community building often matters more than transaction volume. Projects frequently weight social engagement and community participation alongside on-chain activity. This means being active in Discord, providing useful feedback, creating content, or helping other users can be just as valuable as making transactions. However, this doesn't mean spam posting in Discord channels or creating low-effort content. Projects can usually distinguish between genuine community contributors and people trying to game social metrics. Authentic engagement requires actually caring about the project and adding real value. Let's talk about portfolio approach to airdrop farming. Instead of going all in on single opportunities, successful farmers typically maintain active involvement with 5 to 10 protocols across different categories and ecosystems. This diversification increases the odds that at least one significant airdrop will materialize. The key is choosing protocols that you can engage with naturally and sustainably. If maintaining activity across 10 protocols feels like a full-time job, you're doing it wrong. Each protocol should serve some legitimate purpose in your broader crypto activities. Risk management is absolutely crucial but often ignored. Never put money into airdrop farming that you can't afford to lose completely. The vast majority of speculative protocols either fail entirely or deliver disappointing airdrops. Treat it like venture capital. Expect most investments to fail while hoping for occasional home runs. Also be aware of smart contract risks. Using new unaudited protocols for airdrop farming exposes you to potential exploits or bugs that could drain your funds. This risk alone often outweighs potential airdrop rewards, especially if you're farming with significant amounts. Here's a framework for calculating whether an airdrop opportunity makes financial sense. First, estimate the time commitment including learning about the protocol, making initial transactions, and ongoing maintenance activities. Value your time at whatever you could realistically earn elsewhere. Second, factor in all costs including gas fees, opportunity cost of capital tied up in the protocol, and potential smart contract risks. Third, make conservative estimates about potential rewards based on similar historical airdrops, not optimistic projections from farming guides. If your expected hourly return is less than what you could earn in a part-time job, the airdrop probably isn't worth pursuing unless you genuinely enjoy using the protocol or find it educational. Let me address the elephant in the room. Most airdrop farming guides are created by people who make more money selling the dream than actually farming airdrops themselves. The YouTube channels and Twitter accounts promoting airdrop opportunities often have financial incentives to drive activity to specific protocols. This creates perverse incentives where the most heavily promoted opportunities are often the least profitable ones. The truly valuable airdrops usually don't need aggressive marketing because they attract users organically through superior products. Be especially skeptical of guides that promise specific dollar amounts or use phrases like guaranteed airdrop. Legitimate airdrop speculation involves acknowledging significant uncertainty, about whether rewards will materialize and what they'll be worth. The tax implications of airdrop farming are complex and often overlooked. In many jurisdictions, received tokens are taxable income at fair market value, even if you don't sell them immediately. This can create situations where you owe taxes on tokens that later become worthless. Additionally, all the transactions involved in farming generate taxable events that need to be tracked and reported. The administrative burden of managing taxes for dozens of small airdrop activities can quickly become overwhelming and expensive if you need professional help. Some practical tips for anyone still interested in pursuing airdrops. Use dedicated wallets to keep airdrop farming separate from your main crypto activities. This makes tax reporting easier and reduces the risk of exposing your primary funds to experimental protocols. Set clear time and money budgets up front and stick to them. It's easy to get sucked into the gamification aspects of airdrop farming and spend way more resources than originally planned. Treat it like entertainment with a potential financial upside, rather than a serious investment strategy. Keep detailed records of all activities, costs, and rewards. This information is essential for tax purposes, but also helps you evaluate which strategies are actually profitable and which ones are wasting your time. Focus on learning and skill development. Even if specific airdrops don't pan out, the process of researching new protocols and understanding emerging technology can be valuable for making better crypto investments overall. Don't let airdrop farming become your primary crypto strategy. The most successful people in crypto focus on long-term investing, building businesses, or developing technical skills rather than chasing speculative rewards. Here's my honest assessment after years of observation and participation. For most people, airdrop farming is not an efficient use of time or capital. The hours spent could usually generate more reliable income through traditional work, or be invested in developing skills that have long-term career benefits. However, for people who genuinely enjoy exploring new crypto technologies and have realistic expectations about returns, it can be a fun and occasionally profitable hobby. The key is approaching it with the right mindset and strategies. The people who make serious money from airdrops are usually those who are going to use these protocols anyway for legitimate purposes. They're builders, traders, or investors who engage with new technologies naturally and happen to benefit when airdrops occur. If you want to maximize your chances of meaningful airdrop rewards, focus on becoming someone who legitimately needs and uses cutting-edge crypto infrastructure. Be an early adopter because you see value in the technology, not because you're chasing speculative rewards. The future of airdrops will likely become more sophisticated at distinguishing genuine users from farmers. Projects are already implementing complex algorithms that consider factors like transaction diversity, time patterns, social engagement, and even on-chain identity verification. This trend favors authentic users over mechanical farmers, which is probably better for the overall ecosystem, even if it makes farming less profitable. Projects want to reward their actual community, not people gaming their metrics. So, are crypto airdrops worth it? For most people, probably not as a primary activity, but as a potential bonus for genuinely using innovative crypto projects, they can occasionally provide nice rewards. The key is approaching them with realistic expectations, focusing on quality over quantity, and never letting speculation override genuine utility. If you've made it this far, you're clearly serious about understanding this topic. Remember that the best investment you can make is in your own knowledge and skills. Whether that's learning to code, understanding DeFi mechanics, or building a business, those activities create more reliable long-term value than chasing speculative airdrops. The crypto space is constantly evolving, and new opportunities emerge regularly. Instead of trying to game every system, focus on understanding the underlying technology and finding ways to create genuine value. That approach not only increases your chances of airdrop success, but also positions you for long-term success in crypto, regardless of whether specific tokens ever materialize. What's your experience with airdrops? Have you had any big wins or disappointing failures? Let me know in the comments below. And if you found this analysis helpful, make sure to subscribe and hit the notification bell, because I regularly break down complex crypto topics without the hype and misinformation you'll find elsewhere. Thanks for watching, and remember, in crypto as in life, there are no shortcuts to anywhere worth going. Focus on building real value and understanding, and the financial rewards will follow naturally. See you in the next video.